One of the best performing stocks in America right now is a chain of pawn shops, not a tech company, not an AI lab, a pawn shop chain. I need you to sit with how strange that is for a second because it's the whole video. There's a man named Jacob sliding a snap-on tool set across a pawn counter in suburban Detroit. $3,000 of tools, the exact tools he uses to make a living. He's an HVAC tech, $80,000 a year, and he'll show up to a job tomorrow morning. By every official definition, he's doing fine, and he's pawning his livelihood to make it to Friday. Here's the part that should bother you. The company that just took Jacob's tools, its stock has doubled in a year, while the S&P 500 returned a fraction of that. Same economy, one man pawning his livelihood, one chart going vertical off the back of it. My name's Nick, and today we're figuring out why both are true at once, and which one you should actually believe. Let's start with what Jacob just did, because most people get the mechanics wrong. He didn't sell his tools. A pawn loan isn't a sale. It's a loan, and the tools are the collateral. He hands them over. The shop hands him cash, and he's got a window to come back, repay the loan plus the fees, and walk out with his tools again. Miss the window, the shop keeps the tools and sells them. Simple. Here's where it stops being simple. Say you borrow $500 against a wedding band. You hold the loan for 90 days. Over those 90 days, you're going to pay somewhere around $300 in fees and interest to get that band back. $300 on a $500 loan for 3 months. Run that same $500 through a credit card for 90 days and it costs you about $30. So the pawn loan is roughly 10 times more expensive than the piece of plastic everybody warns you about. Effective interest rates in this world run anywhere from 60% to over 200% a year, depending on your state. That makes your credit card look like a charity that sends you a birthday card. So why would anyone do this? Because there's no credit check, no application, no waiting. You walk in with an object, you walk out with cash, and nobody calls your boss or pulls your score. For someone who needs $400 by Friday or the lights go off, the pawn shop isn't the worst option. It's the only option. And here's the part that should reframe the whole thing for you. Most of these loans get paid back. The industry redemption rate runs around 80 to 90%. People do come back for their stuff. Jacob almost certainly intends to come back for his tools, but the fees don't come back. They're gone the second the deal is done. So you've got millions of people borrowing small amounts, paying enormous rates, getting their stuff back, and then doing it all again next month. It's not a one-time emergency. For a lot of people, it's become the plumbing. Now, keep that word in your head, plumbing, because that's exactly what Wall Street figured out. And it's why that pawn shop chain is one of the best performing stocks in the country. The two big public pawn companies are First Cash and Easy Corp. And in early 2026, First Cash did over $1 billion in revenue in a single quarter, up 26% from the year before. Their pawn loans on the books hit a record. $851 million out on the street, lent against people's stuff, all at once. The stock roughly doubled over the prior 12 months, while the S&P 500 returned a sliver of that. Let that sink in. The single most boring business in America, lending money against power tools and wedding rings, outran the entire technology-driven stock market. S-Corp told the same story, revenue up 46%. And here's a detail that does a lot of quiet work. The average pawn loan size jumped from around $160 a few years ago to around $240 now, 50% bigger. The desperation, at least, is keeping pace with inflation, which is more than you can say for wages. So why is the market in love with this? Because investors aren't betting on reselling old guitars. They're betting on the IOUs. The thing that's growing fastest inside these companies is the loan book itself, the debt against household property. And when Wall Street pays up for a lender, it's making one specific bet. It's betting the loan book keeps growing. Read that back slowly. The market is pricing in more pawn loans next year than this year. That is not a bet on the economy getting better. That is a bet on the squeeze continuing. I'm going to give this its own name so it sticks, because once you have a word for it, you'll see it everywhere. Call it the desperation spread. It's the gap between the index hitting record highs and the lender of last resort posting record loans. And right now, the smartest money in the world owns both sides of it. Here's the part that turns a finance story into a gut punch. The same asset managers running your retirement own big chunks of these pawn companies. Vanguard alone held around 9% of First Cash, something like $900 million earlier this year. So the same firm managing your 401k is collecting a cut every time someone like Jacob rents his own tools back at 200%. Your retirement and his rock bottom are, it turns out, sitting in the same fund. Okay, so who is actually walking through these doors? Because if your mental image of a pawn customer is a guy in a back alley, that picture is about 40 years out of date. The operators will tell you the customer has gone suburban and gone upmarket. It's small business owners coming in with Rolexes. It's tradespeople with $2,000 and $3,000 tool sets like Jacob. It's women pawning jewelry they inherited. A real chunk of the new growth is households earning between $60,000 and $100,000 a year. These are people with jobs, people with retirement accounts, people who, on paper, are the middle class. The pawn counter stopped being where you go when you're poor. It became where you go when you're employed and still can't make the timing work. There's a pawnbroker in Detroit named Michael Goldstein who's been doing this for 40 years, and he said something that should be the thesis of this entire video. He said, you can see how the economy's going by looking at what's happening in your store, even sometimes before Wall Street. He calls his shop the canary in the coal mine. When gas prices climb and unemployment ticks up, he says, my customers are hurting, and he sees it months before it shows up in a headline. Now layer one more thing on top because it explains why this is spreading into neighborhoods it never used to touch. America is quietly losing its bank branches. The country went from around 86,000 branches in 2017 to roughly 73,000 by the start of this year. Over 900 closed in a single year. And the closures land hardest in lower income and working class areas. So picture the timeline. The bank packs up and leaves the strip mall. And a lender that charges 200% moves into a unit 3 doors down. One kind of credit got pulled out of the neighborhood at almost the exact moment a far more expensive kind got dropped in. That's not a conspiracy, it's just what fills a vacuum, so that's the ground floor. Now let's take the elevator up to the penthouse because the view from up there could not be more different. The stock market in early 2026 is not just high, it's historically eye-wateringly high. There's a measure called the Shiller-Cape ratio. It smooths out earnings over 10 years so you can see how expensive stocks are versus history. It's sitting near 43. The only time in 145 years it's been meaningfully higher was December 1999, 3 months before the dot-com bubble detonated and the NASDAQ proceeded to lose nearly 4/5 of its value. So we're parked in the second most expensive market in the history of the country, waving at the most expensive one in the rearview mirror. And households are all in. Americans now hold a record share of their financial assets in stocks, higher than the dot-com peak, higher than 2007. Everybody's in the pool, and the pool has never been more crowded or more expensive to swim in. And normally, this is the moment where someone reassures you that if it all wobbles, the Fed swoops in, cuts interest rates, and catches everybody. That's the reflex we've all been trained on. Except this time, the Fed mostly can't. Inflation flared back up on the back of energy prices, so instead of cutting, they're sitting on their hands, and at their last meeting, more officials disagreed with each other than at any point in over 30 years. On top of that, almost everyone with a mortgage already locked in a rate below 6%, so even if they did cut, it wouldn't reach them. The fire escape everybody's quietly counting on is welded shut. Hold on to that, because it matters more at the end of this than it does right now. Here's the line that ties it all together. In 2025, the top 20% of earners spent more than they ever have, and the bottom 80% spent less, and their spending hasn't beaten inflation in 6 years. 6 years. So when you hear that the consumer is strong, understand what that actually means. It means one consumer is strong. The one who owns the stocks, the one whose portfolio just doubled is out there spending, and their spending is so large it papers over everybody else, quietly drowning underneath it. This is the K-shaped economy, and the K is the whole story. One arm of the letter goes up, the other goes down, and they start from the same point. From a distance, on the aggregate chart, it averages out to a flat, healthy-looking line. Up close, it's two completely different countries that happen to share a currency. And the distress isn't a vibe, it's in the numbers. The personal savings rate fell to 3.6%. The lowest in years, meaning whatever cushion people built up has basically evaporated. Subprime auto loan delinquencies pushed past their level during the 2008 financial crisis. Sit with that. People are falling behind on their car payments at a worse rate than during the Great Recession. While the market sets records, then there's the one that genuinely stops me. A record number of people are pulling money out of their 401ks early for hardship. We're talking about cracking open the retirement account, eating the taxes, eating the penalty to cover an emergency right now. The top reasons people gave were avoiding eviction and covering medical bills. That is the financial equivalent of burning the furniture to heat the house. And it's happening at the same time. The stock market inside those same accounts is hitting all-time highs. People are setting fire to their future to survive their present. And the fire is made of the very thing that's supposedly booming. Want the same story without the pawn shop? Go to a dollar store. On their most recent earnings call, Dollar General's CEO said the biggest jump in new customers came from households earning over $100,000 a year. The six-figure household is now trading down to the dollar store. He even named the trigger. When gas hits $4 and stays there, he said, the trade-in starts and our core customer needs us most. That's the same paycheck timing squeeze the pawnbrokers describe, just one rung up the ladder. Target, then Walmart, then Dollar General, then the pawn counter. It's a staircase, and a lot of people are quietly walking down it. All right, time to pump the brakes on myself, because if I just keep stacking scary numbers, I'm doing the exact thing I can't stand, which is selling you a panic. So let me argue the other side as honestly as I can, because the other side is real. Start with the pawn boom itself, because it isn't pure desperation, and I'd be lying if I said it was. A big piece of it is gold. Gold's been near record highs, and gold is what most pawn loans are secured against, so when the metal climbs, the same bracelet backs a bigger loan, scrap revenue jumps, and the whole industry's numbers inflate without a single extra person being in trouble. S-Corp's scrap revenue alone jumped 64%, and a lot of that is just gold being worth more. So part of that gorgeous stock chart is a gold story, not a misery story, and you should be suspicious of anyone who waves pawn revenue at you and calls it pure pain. The same caution applies to the market itself. The S&P 500 is really a handful of giant tech companies earning money all over the planet from products that have almost nothing to do with whether Jacob makes rent. A record index and a stressed out median household aren't actually a contradiction. They're two different things we lazily talk about as one. And it's worth remembering that the bears have predicted 40 of the last 3 recessions. Somebody loudly calls the top of this market every single year, and the market keeps responding by going higher and personally insulting them. The Fed isn't forecasting a downturn. The job market, for all its cracks, keeps adding jobs. So the honest version of this video isn't the crash is coming. It's the floor is a lot thinner than the chart admits, and that thinness is the entire point. Here's the asymmetry. When the savings rate is healthy and people have a buffer, the economy can absorb a shock, a layoff, an energy spike, and bend without breaking. When the savings rate is at 3.6%, when subprime borrowers are already past 2008 levels, when people are already raiding retirement accounts and pawning their tools just to make a normal month work, there is no buffer left. The system is running with no slack. And remember that welded shut fire escape, the Fed that can't cut. A system with no slack and no backstop doesn't need a big disaster to break. It just needs a slightly worse Tuesday than usual. That's what the pawn shops are seeing that the stock market isn't. The market is a forecast, a bet on next year's corporate earnings made mostly by people whose own finances are fine. The pawn counter is a measurement, a reading of how many people right now, today, couldn't make the math work without renting their own possessions back at 200%. One of those is an opinion about the future. The other is a fact about the present. And when they disagree this loudly, it's at least worth asking which one usually turns out to be wrong. So here's the honest landing. This isn't a crash prediction. The desperation spread can close in two directions. Main Street could heal, incomes could catch up, the savings rate could climb, and the gap closes from the bottom. Or the market could remember that it's standing on a base of consumers who are tapped out, and the gap closes from the top. Nobody reliably calls which or when, but you don't need to predict the weather to notice that an awful lot of people have stopped wearing coats. Which brings me back to Jacob and that Snap-on set sitting on the glass. Whether he ever walks back in and slides his ticket across to reclaim it comes down to a single number, whether next month is a little better or a little worse than this one. That's the entire margin he's living on, and there are millions of him. People with jobs, with degrees, with retirement accounts living so close to the edge that whether they keep the tools they need to earn a living depends on whether one ordinary month goes slightly sideways. That's not a crisis you'll see on a front page. It's quieter than that. It's a guy in Detroit doing everything right, hoping for an unremarkable month. Now, real quick, because this is the question I get more than any other. People watch a breakdown like this and ask me how I actually find this stuff. The pawn earnings buried in a footnote, the dollar store quote nobody reported on, the savings rate hidden 3 layers deep in a government release, and then how I turn it into a video people actually watch. That's exactly what I teach inside our school community. It's where I walk through the entire process, start to finish. How I source these stories, run the numbers, structure a script that holds attention, and build a faceless finance channel from zero, even if nobody ever sees your face. If you've ever watched one of these and thought you could do this, the link's in the description, and I'll see you in there. All right, before you go, here's what to actually watch. So you're reading the signal instead of just doom scrolling. If the savings rate climbs back over 5 or 6% and those subprime delinquencies start to cool, that's the gap closing the good way, a real green light. But if the savings rate slips under 3 and pawn shops start reporting that people aren't buying their stuff back, that the redemption rate is falling, pay attention, because the day people can't even afford to reclaim their own collateral is the day the canary stops singing. Until then, keep your own buffer fat. Keep your fixed costs lean, and don't confuse a record high market with a healthy one. They are not the same screen. And if you want to learn how I take a signal like this one and turn it into a channel, you know where that school link is. My name's Nick. Hit subscribe, and I'll see you in the next one.